Hello, friends. Good afternoon to you. Just about ready to get this thing started. Some of you are already in the chat. I see that. If you could hit the like button, it's the best and easiest way for you to support this channel. Thess says the mic is good. You hear me? Beautiful. Let's go. Or as BCB would say, here we go, here we go, here we go, here we go. Hello. Welcome, friends, to Alpha Beta Soup. I'm TXMC, your boy. Here we are on Thursday, November 9th, 2023. It's 11 a.m. in beautiful Austin, Texas. If you haven't hit the like button, please do so, but it seems like most of you have. Really good to see everyone today. This has been a fun few days, right? Bitcoin basically tagged 38K this morning. On a few different exchanges, it was over 38. On Coinbase, the high is 37,999. It's fun. You know, when we talked last week, we were in the mid-range of this like gap, right? We talked about this. I drew this little parallel channel. And last week on the stream, we were right in here, just kind of bumbling around, hanging around. November 2nd, what day was that? It's right here. We're floating along on top of it. We're like, okay, are we going to find this as support and just keep grinding higher? And sure enough, we went up and we tagged that level. And that's a level that I've had my eye on for a while now. It's the bottom of the up move here that led to the breakdown that broke market structure from the bull run. Right? If we look at like this, well, I mean, I don't really have to draw a specific line even. If we just kind of like look at this area here as the floor of the bull run, and this was our general bull market structure. We had an up thrust here. This was in March 2022 with this move up, and that just led to the breakdown. And so the bottom of this area is a place that I've been looking at, right? Because that's where we started getting these clean candles. This is on a 3-day chart. We started getting these clean candles, and this was the swiftness of the move. This was the Luna wick down here at the bottom. And so we've pulled back up into this level, and you know, we've seen a little bit of liquidation today. I can pull up Velo data, the homies at Velo. These are, this is a great data provider. I like to go look at them for futures data, liquidations, open interest, stuff like that. I really like their platform. It's super slick. And the guy who develops it is a former Glassnode alum like myself. So I like to support him when I can. BitHedge is his name on Twitter. But we can see on here, this is open interest. This is futures positioning in dollar terms aggregated across all of the Bitcoin futures instruments. This is just Bitcoin. This isn't all of crypto. And when we saw that wipeout today at 38K, right, at this level, if we go down to like a 4-hour chart, you can see it. You wicked up, and then we've had a bit of a wipeout. A lot of other alts just got roasted in this wipeout here. You know, some of them have fallen 10, 15, 20%. But that move took out basically perfectly $1 billion of open interest. Where's the measuring tool? I always lose it on here. Right there, 1.2 billion. It's a little bit more now. It kind of depends on where you measure, but call it $1 billion. If we zoom out, there was another liquidation, you know, cascade, whatever you want to call it, like this back in August. Over here, this one was about twice the size. This was about 2 billion. This over here is closer to 1 billion. But we like to see that positioning getting rinsed out, especially when it's been building up as much as it has. And when you zoom in here and you see where this like pile up really began, it was at 35K, right? Here's 35. Here's us hovering at 35,000. Let me shrink some of these others, and it's probably be a little easier to see. Here we are consolidating just above 35,000 right here. And then we finally climb up, and there's all this positioning started building up over the last $2,000-$3,000, and we just closed a bunch of it. I don't know how much that is in liquidations, because to be completely honest with you, the liquidation numbers are often bullshit because the exchanges don't report on liquidations the same way. Some of them don't report it at all. So we don't actually know the liquidation number. These numbers are a lot smaller than this figure right here. This is $1 billion, and this only shows like 10, 20, 30 million worth of liquidations. So I don't really pay attention to liquidation numbers, figures. I don't really care about that. But just in terms of OI size, that's a big wipeout, right? Took out a couple weeks. Oh, no, not weeks. Sorry. A couple days of buildup. So that's good. That's healthy. You kind of need that on the way up, especially after we had this long grind and then we had a quick pop up into resistance, right? This is the resistance level we were just talking about. When you get one of those and that quick move is accompanied by a lot of positioning, usually you see some of that get quickly resolved in the other direction into resistance or down into a support level. Conversely, same thing. So that's been really cool. And if you're a trader, there's been really good action in crypto the last couple of weeks. Altcoins are just absolutely mooning. And there's been a lot of money added to the total 3 market cap. We talked about this in the last stream. About 88 billion or so since the middle of October has been added to the total 3 market cap. That's the altcoin market cap minus Ethereum. And, there's a lot of coins that are really extended. And, I don't do nearly as good of a job as covering the altcoin market as some of my friends in the space do. So I'm not going to try to imitate their analysis or anything like that. But, some of the leaders like Link, I think it just broke out of its 200-week moving average. Yeah. Just ripped up to its 200-week moving average. And what do you know? Everyone's super bullish on Link right here. But how high does it really go? I don't know. Maybe up into the May, April retracement levels before the Luna Wick last year. That could be a good spot for it to find some resistance. And then we're pretty close to that area now. So who knows really that as far as Link goes. I don't really care about Link. But, you can just see the strength of this move everywhere. Solana going all the way up to $48. It was down here at $15 in June. So it's essentially, tripled. That's the kind of strength that we've been waiting to see. I mean, how long has it really been since there was any move like this? We haven't had a real retracement at all during this bear market. We're finally above the 236 on the total crypto cap. But even that's a piddly excuse for a retracement. We even had more than this back before Luna collapsed, right? When our low was January of 2022, we rallied all the way up about 45% in terms of retracements. So I expect that if we don't get any surprises in the market, there's no reason to think that this won't get up in here, right? Similarly to Bitcoin, the same exact kind of resistance area right here. Same thing it is on BTC, right? It's just that the total crypto cap isn't there yet. So maybe it's got some more room to run. That's another $300 billion. Who knows if that actually gets added to the market cap? But with the amount of strength that we've seen recently, and if BTC can actually get up through 38K and then maybe pause for a little while, we could see that kind of rotation that could push crypto a lot higher. If we look at it, we look at the dominance figures. I like to look at this sometimes. I don't show it all that often, but it's interesting to look at for rotations. And so what we've got on here, this is just a momentum oscillator of advancers and decliners in the crypto market using like I think I used the top 40 coins because TradingView only lets me put 40 coins in an indicator, and I wrote this indicator. But when it's climbing, it's like a MACD for breadth in crypto. When it's climbing, more and more names, tickers, are rising on a moving average basis. When it's falling, more and more names are declining, right? So it's breadth inside of crypto. This is Bitcoin dominance, this is Ethereum dominance, and this is everything other than these two and stable coins. So this is basically from XRP all the way down minus stable coins, their dominance. And from basically since the rally began in the third week of October, we've seen a 2% increase in altcoin dominance during a period of time where BTC was kind of languishing. Languish is not the right word. That's not a fair word. It was just slowing down here during this period where it was just grinding really slowly higher, and we were wondering if it was actually going to roll over. Some of my friends came out and they shorted this, and they were expecting it to come back down. They've probably closed those at this point. But during that period, BTC kind of flagging a bit, for lack of a term, flagging in dominance terms, that was when the altcoins really started taking off. Ethereum did not, however. It's been languishing. It has actually been languishing. And if we look at it, it's way down here, right? Like BTC is already said goodbye to its range highs. It's well above them. It did that. Oops. Let me put the line on here. It did that back here, right? Like it's been over them since October 22nd on a 3-day chart. Probably a different day. What is it? Okay, 23rd of October. But Ethereum's still below its range highs. It's getting there. It's catching up now. And you can see some of that lag is now starting to play in for Ethereum. As these alts have pulled back, Ethereum has maintained some of its strength as it's been breaking out today. Following BTC, maybe we'll start seeing some strength in Ethereum. And if we do, then maybe this ETH BTC chart will stop looking like absolute fucking death. This just looks terrible. Everyone's been kind of waiting to see some strength in ETH, and it hasn't shown it yet. Maybe we're starting to get those first signs of it. But we've been kind of in this range here. This is from, the 2018 bear market right here, this little range that we've been in, and we just tagged the lows, and it looked like we were even forming a low, and perhaps we have. Maybe this is exactly the kind of structure that you want to see if you are an Ethereum bull, right? I have some Ethereum. I don't really consider myself an Ethereum bull, but of course I'd love my bags to be worth more money so that I can pay myself a higher amount. But here, look at that higher low, right? We broke down outside of the range. We started to form a base here over a few days. This goes back to October. We broke higher, come back down, tried to create a lower low, but instead it was a higher low. And now we're climbing back up inside the range. And it looks like we might have just climbed over this line here. We did. Got a bit of a wick there. So this is a tiny range in and of itself. To be fair, this is a small range. You can always kind of find a range within a range like this. So, we'd like to see some strength over top of this. Now that we've formed the right structure, we have the higher low, then you want to see this like this, right? You want to see the same structure forming on top of this and it turning around. And if that's the case, then maybe Ethereum's going to wake up a little bit here. And if Ethereum wakes up, then I think more alts will wake up. Other alts that maybe are more sympathetic to Ethereum, maybe they're built with Ethereum tech, or that just are generally more correlated to it, they'll start to wake up, because so far the rise has been positive for most of crypto, but it's definitely more concentrated in certain areas, like some of the gaming tokens taking off, and some of what people see as future L1s chasing them. And then, now we finally get Ethereum waking up. So we'll see how that goes. Over in TradFi, what's going on over here? A slightly green day. And, the S&P put in a remarkable rip. This is an utterly wild rip that recovered this entire fall in about half the time. And there is an adage that I tweeted about this. It's a bearish thing to say, but it's something that I remind myself of whenever I see a really strong move, especially in equities like this, where it doesn't happen as often. It's less of a thing in Bitcoin when I just see a rip in BTC. But if I see a sharp corrective move in equities, then the thing I like to remind myself is that counter trend moves tend to be much faster and cover a lot of ground in a much quicker period of time than moves in the direction of the primary trend. So you can see, look, slow grinds down, quick pop, slow grinds down, quick pop, slow grind, slow-ish grind down, quick pop. The same thing on the way down over here, right? Like some of these moves are kind of sharp, especially from the very top. But look, quick move up and then multiple weeks of falling, couple of months of falling, quick pop. This is a massive sell-off in June, but for the most part, you can see how this plays out. We get these really strong rallies, and then it tends to drift lower for a longer period of time than the initial break higher. And that's indicative of a bear market rally. So the question I'm asking myself, and I think a lot of people are asking themselves, is this a bear market rally, a small one, maybe indicative of this not being the new primary trend? Maybe this move higher is still part of the secondary move. And so the question then is, okay, well, it does look bullish here. Looks great. Don't get me wrong. But is it, there's questions, there's layers of questions. The first one is, does it get over this level? It hasn't even done that yet. So let's not get too excited. Let's set a higher high on the daily chart. And then once we set a higher high on the daily chart, the question then becomes, from a market structure perspective, because that is very important, is it going to be a lower high? If it sets a lower high, is it going to be relative to these daily pivots? And so then it would just hold this level and it would get really close. And that's all she wrote. Or is the lower high based on this level, right? Which is more of a high time frame level. Because if you look at it on a weekly chart, these little pivots here are not really that significant. And so for a market of this size, and particularly after a move of this length and this percentage, then you don't want to get caught up in one or two candles deciding your entire bias. You need to let it breathe. So the question I'm asking then is, okay, if we get above this level, well then we're not home free, because we have to get above this level. This is actually the real test. If it doesn't even get above here, then that's a sign of real weakness, right? Like, that's a big problem. I would expect that to be surmounted and for this to keep drifting higher, maybe through the end of the year, maybe not at the pace that this was at. But that's just me kind of editorializing a bit based on what we've seen in the past and the tenor of this move here. So we haven't quite set a higher high. I mean, maybe we just peaked above it. We've flirted with it. We go look at the NASDAQ 100. It has done that. So now it's in that phase. Okay, we've been having this flagging pattern here, and we've set lower lows on a daily structure. Now we've set a higher low on the daily structure. Is the whole thing turning? Okay, I don't know. Let's watch for it to get up here, because in this area here, we've still got some retracement levels to battle through. Let's slap a fib on here. We're at the 702 for this move on the NASDAQ. And this is the danger zone. It's right here, right? Y'all know this. And we've talked about that a lot, going back to the early days of the channel. Like even in the early days of the bear market, the talk was, what happens if we get back into a retracement of some kind? If we have a bounce, we actually have a rally after the bear, what do we do when we get up into those levels? It's the same question we're asking ourselves about Bitcoin, right? So it's the same retracement areas as well. It always is. It's always those spots. If you slap a fib on here, like, yeah, we're all the way down here, but this is usually where rallies run out of steam. I don't know if Bitcoin's going to get up here, but if it did, that's the scary spot, right? I was listening to my buddy Blockchain Backer do his live stream a couple hours ago, and he said the same thing. I agree with him completely. Like, down here isn't really the scary place. This is where we thought it should get to. Like, just rationally, that's like a bare minimum bounce in the market, right? Mid-cycle pump, whatever the hell you want to call it. That's kind of the bare minimum to at least get over this level once and find out what's above it. But this is really the scary place. Really getting over the 0.5 is key, but it's this area where rallies often run out of steam, right? And so I'm looking at that over here on the S&P and thinking the same thing. This is the NASDAQ. Is it going to get through these levels? Is it going to get over this? Are we in a new bullish uptrend? I don't actually know. Within equities, we have some different behaviors. Like, we have Microsoft. Microsoft has now set a couple of all-time daily high closes, even though it hasn't actually set a new all-time high. It's set new higher daily closes. Before, this was the highest all-time daily close right here. And so in the last 3 days, it has broken above that. And it looks like maybe it's running out of steam. Look at the wicks. right? We had these strong candles. The bodies are getting smaller. The wicks are starting to come out. Maybe it's running out of steam. This is the kind of detail that you need to pay attention to if you're going to look at a candlestick chart. It's not just the price level and whether the candle is green or red. It's the style of the candle, right? Is it a huge body that has no wick above it and price closed literally at the highs? Or are we starting to see sell pressure? This manifests even more so on crypto where we have more volatility, but you can see it on these bigger assets as well. We're starting to see that on Microsoft. Maybe it breaks up. I don't really know. But other things like Apple still have a lot more work to do, right? Like Apple's actually way down here. Apple is still below its 618 retracement. And so there's still a lot of unanswered questions as far as equities go. You know, NVIDIA has been one of the darlings of the year. A lot of people, including myself, think it's rational that this gap should be filled back in at some point, particularly since the prior all-time high resides within it. It would seem to me, especially after we had this level here get broken, I thought, okay, well, maybe we're actually going to drift down and we're going to start closing in that gap. But this became a sweep of the level. It became a swing failure. And now we've come back up and set a new high on NVIDIA, a new local high, right? We're on the way back up. We're climbing back up. And from this move here, we are at the last retracement. We're just relative to this piece here from like August to October for NVIDIA, it's at the last retracement. It's kind of at the last battle before it presumably climbs back up to test its prior high. Let me take a sip of my water. If you have not hit the like button, which about half of you have not, about 50% of you have not yet smashed the like button, please take a couple seconds to do that while I take a couple of seconds to hydrate myself. All right. DXY, I did want to talk about DXY. So the key takeaway for equities right now, you know, I'm not a fractal king. I'm not someone who knows Elliott waves. I'm not going to try to predict price. So don't ever ask me to do that. That's just not my specialty. I do have a bias though. Right now my bias is bullish and I'm waiting to see. That doesn't change my recession thesis, by the way. Those are separate things on separate timelines, and they can coexist. That is important. I get asked that quite often. Currently, I am bullish on the near term, presuming that we see equities climb over these levels right here. That's what I'd really like to see. If it can't do that and it starts breaking back down, well, then we have to look for the midpoint of this move. And that is right here at this gap. You see that? On the S&P, on the SPX, it's about 42.50. And so then I would start looking at this area and say, well, I'd really like us to hold this. You know, if you're bullish, then you'd want to see maybe this gap get closed, which is right at about the 0.25 place inside of here. Let me show you what I mean. If we break this into quarters, this is about the 0.25 area inside of this big area here, this big range. And so maybe we get back into here. If we're gonna find this as some resistance, maybe we come back in here, and then that's the test. Then that's what we look for. At the very least, must hold that range. If we started getting below here, well, then this is the high, in my opinion, and we'd have to start looking down here. That's just like range trading, right? Basic range trading. That's how I would look at this structure here. And based on what we were just talking about, with the dynamics of candles, things like that. You have all of these green days up. The bodies start getting smaller. The wicks start getting longer. And now we have a couple of red candles in here right at resistance. So just keep your eye on that. DXY, we want to touch on DXY here, and then we'll look at some stuff in Tableau. There's a couple of different things I want to talk to you guys about. After we look at this, by the way, we'll touch on some of the recession things, and then I want to talk a little bit about Bitcoin on chain and some of the stuff I've been tweeting about recently. So we've been watching the DXY and been watching the Wyckoff accumulation form here over many months. You guys know that I was bullish on DXY. I literally called the Pico bottom. I called the Wyckoff spring, and I brag about it because I don't call that many things correctly, and that was one of the few that I got. So, props to me, I guess. But anyways, what we're watching right now is this area. See this sign of strength on the Wyckoff schematic? If we are indeed playing out this thesis, and we're still doing so, then one would think after we have had this spring and we have moved higher, that we're now consolidating above prior support, above the range, and that is sign of strength. Kind of what it looks like here. And what you want to watch for is the same kind of market structure that we were just talking about with the NASDAQ and the S&P. Where now, look, we see these candle bodies. You see compression up into resistance. You see the wicks showing up on the DXY. It looks like it wants to curl like this and go down, back down towards the mid-range, toward 103s, 103.5. If that's the case, that is bullish risk assets because that is the denominator going down in value. So that's something I have my eye on. If I would assume, being a relatively novice Wyckoff enthusiast, I would assume that if this is a sign of strength consolidation, that we wouldn't want to see DXY spend a lot of time figuring out if this line is support. That sometime in the near future here, in the next week or so, you'd want to start seeing it move higher decisively and say, okay, we're done with this range for now. And then if we get that, then where are the next levels higher? Well, one of them is right around here. 108, call it. It says 107.9 and change. We'll call it 108. And then the other one is up here about 109.5. And so we're in this little, oops, sorry, I'm moving this around too much. We're in a question mark phase right here. I think with the bullishness of risk and with the fact that the end of the year tends to be a seasonally uplifting time for risk, if the DXY decides that this is not ready to be support and it needs to come back down here for a breather, maybe it comes back down into this area, which is the range quarter, or maybe it comes back down fully to the midpoint, that would uplift risk, I would assume. The same way that from July to here, risk mostly went down. So I'm going to pause here before we move into some of the other charts, and I'll catch up on the chat. Best intro in the space. Thank you, Thurston. Thurston, appreciate you. Have I looked at the aggregated earnings forecast for next year? It's actually really good. So yeah, Icky Matter, I was looking at Bob Elliott, one of my Twitter buddies. He tweeted something recently. It was a few days ago. And he was talking about earnings forecasts for next year and the year after. And essentially, the market is expecting 11 to 12% earnings growth next year and the year afterwards. During a period of secularly high real interest rates. So I don't really know what to make of that. It seems exceedingly optimistic when you look around at what some of the early warning signs are flashing in the economy. Assuming a compounded 24, 25% earnings growth over the next 2 years, that seems ripe to be repriced. And I think that some of that has yet to really make its way into equities and into valuations. Don't forget, the number one way to support Alpha Beta Soup and these awesome live streams is to hit that like button. Thank you, Sick Thinker. That is perfect. Vitruvian Boy, thank you so much for the super chat. Very generous. Keep it up. Appreciate that. Can I talk a bit about my views on the bond market? So I'll touch on bonds, but I want to be clear that this is not a market that I have a lot of experience in. I'm not a bond trader. I don't own any, never owned any TLT. It's just something that I observe because if you watch the markets, you need to pay attention to the bond market. But what I do think is interesting is that basically in middle October through the FOMC we had on Halloween, every Fed governor, basically all of them, came out in public and said that this rise in the long end, in the 10-year and the 30-year, was effectively a tightening for them. and that it would push out rate hikes. It's doing some of their work for them. Jerome Powell said those exact words. I tweeted about this the other day. Let me actually pull it up on Twitter real quick and we'll look at it together. I'll show you where it was on the price chart because that's really the takeaway, I think. Here. This is the 10-year. This is what we're looking at right here. It's the same chart. And right here on October 19th, Jerome Powell said higher bond yields is a tightening and at the margin could reduce the need for the Fed to tighten more. Well, since that day, yields have gone straight down. We've had nothing but a bid on the long end. And so this is a reversal of the tightening of financial conditions. This is an easing of financial conditions. And while this was happening, what else was happening? What we just looked at, the S&P going on a gargantuan rip. 7% in 13 days, which is huge for the S&P to do that on a bounce. That's nuts. And so the Fed is going to have to walk some of that back and reassess. I think because of the growth numbers that we've seen and because of this easing of financial conditions and because Janet Yellen herself, as we talked about last week, she's also doing her part to kind of slow down the bear steepening. She didn't increase the amount of duration that she's going to issue as much as the market thought. So those things have combined to ease financial conditions during a period of time where the Fed was actually really enjoying this in a manner of speaking, because this is what needed to happen. This right here needed to happen for tightening of financial conditions to actually take place. They don't take place on the 2-year. The tightening of financial conditions occurs on duration. It occurs on the 10-year, which is the benchmark for countless other markets, including credit markets. It is the benchmark for many valuations related to equities. It's the part of the basis of the equity risk premium. Like the 10-year going higher is what brings about a tightening of financial conditions. And so if forces have now convened to interrupt that process, well, that is counter to what the Fed is trying to accomplish right now at this phase. So I think that what that does is it puts the possibility of a hike in December back on the table. Doesn't mean it's going to happen, but I think it has to be a non-zero chance. And I would bet, we're going to go look right now, I would bet that the odds for a hike in December have now gone up as the yields have been coming down. What is this? Am I looking at the right thing? Meeting December. Yeah. So there is now a 10% likelihood of a hike. It's actually stayed kind of the same. Okay. Well, the odds have been going down for a hike. That's actually interesting. That's not what I would have thought. Right. So right now we are at this level, 525 to 550. And right now it says 90% based on positioning in Fed funds futures. There is a 90% positioning expectation that the Fed will not hike in December. But there is a 9.5% chance that they hike by 25 to 50 25 basis points. And if you look back in time, 8th of November, that was yesterday. 2nd of November, that was last week, and that was a month ago. You can see that the odds were higher in the past, and they've been coming down, which I think is a little interesting. I would have expected that seeing this move here, especially after the Fed bragged about how this was really helpful for them, that I would have assumed we would see higher odds for hikes in December. But, we've got a few more weeks to go, got another month or so before that FOMC. I think it's December 13th. Yes. So we've got another month to go. We'll see how that changes. And I don't really put a lot of stock into this FedWatch tool. I think it's interesting. And sometimes when there's an overwhelming consensus like this, that's a good observation. But largely, it's not that useful to look at all the time. Okay. Let's look at some of the recession data. So non-farm payrolls growth rate, this chart has not changed since we talked last week. We had this slight uptick in the rate of change of non-farm payrolls, but we're still following the general slowdown from where we were a few months ago, 6 months ago, 9 months ago. We're still following that trajectory, and it's too early to know if we're going to be 1966, which is our closest and best example of a soft landing. But, in the last few days, since I did my last stream, I was thinking, well, because we've been looking at a lot of this through the perspective of the yield curve inverting, right? That's what this x-axis is. It's the months before and then after the 3-month 10-year yield curve inverted. And that has been a really helpful anchor in trying to gauge the rate of change of the slowdown of this economy. That's been very useful for us. But over the last few days, I decided to go a little further with it. And so I started modeling the same things, but relative to the beginning of Fed tightening in each of the prior eras. So from the moment they began raising interest rates until they stopped raising rates, and then likewise until the end of the recession, which does not always align with easing. But I want to just kind of capture what happens from the period of time when the Fed says, okay, we need to increase interest rates for whatever reason. We need to try to tighten financial conditions a bit because growth is really strong, or the economy is just flat out overheated, or whatever their motivations are. Inflation's too high, you name it. And so there's a couple of interesting observations here, and I can feel my myself getting a bit congested. So if you hear me sniffle or something, I apologize. It's just kind of an allergy season here in Austin. But right now, we're looking at non-farm payrolls, the same chart that we've been looking at over here, non-farm payrolls, right? Same thing. And these are all the prior eras. I know this kind of looks like spaghetti, but the way that I look at this is I identify our current era first. That's the black line, right? You can see its trajectory. And then I look at a couple of things. I try to look at, okay, where is it in relation to all the other cycles right now? And you can see that it's kind of in the middle of the cluster. And then I say, okay, well then how soon during this process do prior eras go negative, which is this 0 right here in the middle on a rate of change basis, on a growth rate basis for jobs. And I see that, well, we had this one era, 1981-82, where it happened sooner. But we also know, as students of history, that this was a double dip recession, and that this came just a few months after a previous Fed tightening and easing cycle that created the 1980 recession, which is over here. So this one was one of the earliest. But most of the other eras where we saw job growth go negative relative to Fed tightening was at least 24 months in, right? See, this is 24 right here. This is 2 years. So right around this point, that's where it happened in 1960-61. That's where it happened in the tech bubble recession. And then we've got a few of these other eras that go a little further along. This orange one, the label's not showing up, but it's 1970. And I forgot to mention, there's a difference on these lines. So we've got solid lines, and then they turn into dotted lines. You see that right here? The 2007, 2009 one's a really good example because it has this long period. So what this shows is this is all still the same non-farm payroll growth. But where this line changes from solid to dotted is when the Fed stopped raising interest rates. And then the end of the line is the end of the recession, officially the end of the recession. Sometimes unemployment can continue to rise after the final date that is officially called the end of the recession in hindsight. But from the period of the end of Fed tightening until whenever their recession began, which is sometimes immediate, sometimes it's many months later, from that period to the end of the recession is the dotted line. And so when I look at non-farm payrolls through this lens, what I see is that most of the time, it's at least 2 years after the beginning of Fed tightening that jobs actually go negative. And then what I also see is that very often, after the Fed is done tightening, job growth continues to fall. It continues to fall for many months, in some cases, years, in some cases, 2 years more. And that's because there is an inertia to the economy. And this is something that I cannot stress enough. If you want to study economics, you want to look at things like this. The economy is a massive beast, right? Just in the United States, there's 350 million people. We have a GDP of like $17 trillion. We have a workforce that's 170 million people. And so when we have asset markets that are 50 trillion dollars, and the stock market, I mean. And so when the Fed begins, when it embarks on one of these campaigns and it starts to raise interest rates in order to accomplish its policy goals, it reaches a point where jobs begin to slow down, and that inertia takes hold and carries forth into the future. It isn't something that gets arrested from the moment the Fed stops tightening or from the moment they begin easing. Because I'll tell you what, when the Fed began easing in the 2007-2008 cycle, was somewhere in this period right here. I don't have the exact dot because I'm just estimating based on my knowledge of this data, but it's in this area right here. And employment and the stock market fell for a long time, for like a year or so, while the Fed was easing and while the market and jobs were going down. So there is an inertia to this. This isn't something that you can just push right up to the edge. Then you can flip your policy and it rebounds the way that the stock market rebounded in March of 2020. Jobs do not work that way. They kind of worked that way in COVID because we artificially closed the economy and then we allowed it to reopen. And so there was an immediate rush back of people reclaiming their prior jobs, right? Because they were put on furlough or whatever. And that is abnormal. That is artificial. And that's not natural. That's not what usually happens. This is what usually happens. And if you go through each of these eras, it's consistent, right? Here's job growth. They had some growth. This is the rebound. The wrong era. Here's 1960. You see job growth up, down, very choppy, very volatile. But then the Fed is done hiking and job growth continues to decline for another 10 months. 1970. This does not have a dotted line because the Fed didn't start easing until the end of the recession. This was in the middle of the 70s. This was as inflation was really getting out of control. Now, we know it went a little bit higher a few years later, but I think it hit 10 or 12% during this cycle right here. And the Fed stayed tight well into the recession, which is possibly what they would do today, even though CPI is not 10, 11%. It's, 3.5%, but it's above their targets and it's more than they want to deal with. And they have the memory of the past, the institutional memory of the past. But the 70s, they stayed tight all the way through the end. So you don't get this dotted line. But even so, while they were tightening, job growth was slowing deep into the recession. This is 1970, not 1974. But what I just explained is the same. Inflation was rising. I think it wasn't 10%. I think it was 7 or 8%. I misspoke about which era that it was. But they stayed tight until the end of the recession. 1973-74 was another era where the Fed didn't start easing quickly. They stayed tight throughout the recession, and they didn't start cutting until unemployment had really taken off. You can see the same thing here, right? Job growth falling. They stopped tightening. It keeps falling. 1980, same thing. This was the beginning of the double dip recession that led to this, right? It went down. They started easing. The recession ended. There was a bounce in unemployment. Then they realized, oh shit, it's coming back. Paul Volcker decided we've got to get really tough on interest rates. We're going to let the Fed funds rate go wherever it wants. That happened to be 19.5%. And that's what it did. It shot all the way up. Jobs started coming back down. This is the double dip recession. Same dynamic. Look at that. 1990, long period. 2000, same thing. 2007, same thing. So this is what history tells us. And we're watching this play out. It seems like maybe we've got a few more months ahead of us before we're in that window when jobs really get negative. And I know that you guys hear me say that a lot. I feel like I'm perpetually saying it's a few months ahead of us, but it's difficult, right? If you're going to model the economy in this way, you have to be prepared for the amount of time it takes to play out. And we have known all year that this is a multi-year process. And just from the perspective of Fed tightening, you can see that it is at least a 2-year process. Sometimes it's a 3.5 year process. The Fed began tightening in March of last year. So we haven't even gotten to 2 years yet. It can be difficult. If we look at a different thing, I'm not going to spend as much time on this, but I just want to show you loan creation. This is business loan creation relative to Fed tightening. Now, something that I've talked about before is bank lending standards, and I haven't spent a lot of time on it, but there is a survey called the Senior Loan Officers Survey, and they ask banks how likely they are to make loans for consumers and for businesses, etc. And it comes out and it looks like this. And this is 2 of the series combined because one of them goes longer back in time than the other one. But it looks like this. And what typically happens during a tightening cycle is that the Fed begins to raise interest rates. Federal funds rate. Where are you at? There we go. What typically begins to happen is that the Fed starts raising interest rates. And let me flip these lines over. Let me make these negative. And then we'll flip this one, make this negative. Okay, there we go. Let's zoom in. So what usually happens in the past, what we have seen is that here's, oh my gosh, the tooltips. Sorry, guys. We're doing it live, all right? All right. The Fed raising interest rates. Here's the tightening cycle in 99, 2000. They tighten, and then banks start tightening their willingness to make loans. You see the same thing here in the Great Financial Crisis. This is the tightening cycle. Then they pause. And during this period of pause, that is when bank lending standards begin to tighten, right? This is when banks start going, okay, rates are in a more restrictive territory. We are less interested in making loans. We've already made a bunch of loans when times were easy, and now we're going to make it a little more difficult. That tends to follow after the rate rise. And that dynamic has been pretty steady back as far as this series goes. There's been a little bit of a difference back here in the mid 70s, but that's a pretty common trend. They raise, they pause, then banks get tighter. But the interesting thing is that in this cycle, they have happened concurrently. They've happened since the Fed began tightening, which is right here, March of 2022. The federal funds rate has risen, the red line, and banks have become less and less willing to lend concurrently at the same time. That's the first time we've had that dynamic since the 70s, since all the way back here in 1975, which is one of the eras that most closely resembles the setup of today in a lot of ways. Maybe we'll go into that in more detail at some other time about why that is. But there's a dynamic here, and what this has led to is an utter, complete choking off of credit. I've been walking you guys through this the last few weeks. We continue to look at credit growth and how poor it is relative to prior eras. Here is credit growth in the black line versus all prior recessions relative to yield curve inversion. Look how far below we are. We're like 7 or 8% below it. It's insane. But if you look at it relative to Fed tightening, it's been choked off really soon, far sooner than any other era. And you can also recognize here that this has a similar dynamic to job growth, right? The Fed tightens and then they stop tightening, but credit growth continues to slow for the most part through most of these eras, right? And so if we are already all the way down here, how much worse does it really get? Do we end up looking like 2007, 2009? Well, we don't know when the Fed is done hiking. Maybe they're done now. Maybe we'll look back in hindsight, and the one they did a couple months ago, whenever the last one was, I'm blanking right now. That will be in the last hike. Maybe it was July. So uncertain. But where my mind goes when I look at this and when I look at the job growth is that we have a complete choking off of credit, but we still have employment that is positive. And that is currently the last remaining leg of the stool. If no one is lending, if credit is basically tapped out and it's already slowed down at a faster pace than ever before in history, then that really just leaves incomes as the sole remaining fuel for the economy and people remaining employed. So that's why I have concerns about what's going to happen coming up ahead. So let me stop here. Let me have some water, catch up on the chat, and then I want to talk a little bit of Bitcoin on chain. Oh, we have the same amount of viewers as likes. That's amazing. I really appreciate you guys. Thank you so much. Concurrent viewers still tops out around 200. I got to figure out a way to get that higher. I can't seem to grow the amount of concurrent viewers we have. You 200 that show up every week, y'all are absolute boss OGs, and I love each and every one of you. We got to figure out a way to like double the amount of you that there are every time we go live. I got to think about that. Big Shroom with the donation. Appreciate you and your insights, my man. Thank you so much. Mr. Six says 6061 is interesting, but 1973-75 looks to have started around the same 6-month annualized as the one we're experiencing now. There's a few things about the middle 70s that look kind of like today. I don't think it's going to play out just like that, but we have some similarities. But one of the absolute biggest differences is the labor force. So in the 70s, we had a labor force that was growing very positively. It was growing strongly because we had boomers coming of age. We had female empowerment, women entering the workforce. Both of those things were very powerful drivers of labor force growth. So we had high unemployment throughout the 70s, in large part because there was much more labor supply coming online than the economy had jobs to give to them. There was huge growth in services jobs in the 70s. A lot of people got hired that way. A lot of females got hired that way too. But that labor force growth isn't here today. It's not the same dynamic. We actually have a tight labor market because we have inadequate supply. So that is a key difference between 73 and 74 and today. Also, our inflation is not as high as it was back then by factors, multiple factors. How much do we factor in inflation into drawdowns? Could drawdowns not be as deep as we think? Well, I have a table. I don't think I have it here in front of me. Probably be some work to pull it up. But I have a table that shows drawdowns in bear markets, and they're pretty consistent. Like whether it was an inflationary bear market or not, you kind of get the same outcome. I might actually even be able to make that table here. Let me try that. Yeah. Let me do that. Era. Market low. Percent from cycle high. Throw in eras here. Format. Percentage. And then I'll go back to my other table. Link the dates. Inflation eras. Oh, did I not save it? Okay. No, that's fine. That's fine. Here are the high inflation eras. Look at the drawdowns. Look at these numbers. 37%, 50%, 22%, 28%. 22-23 so far has been 27.5%. But even when we've had high inflation, we've had the same kind of drawdowns that we've had in other periods. Now, the 2000s and the 2007s, those were low inflation periods, and we had a 50% drawdown. So it doesn't, but 1973, 74, that was the second highest period of inflation in the last 100 years, other than 5 years after this, and they still had a 50% drawdown in the market. So I tend not to worry too much about factoring in the inflation component because these numbers are really consistent from all different kinds of inflation. Now, if you go back further in time, the drawdowns aren't as high, but the market also wasn't as high. We weren't as financialized. So you have to take some of that into account. But from basically 1966 onwards, it's been in a pretty consistent range. And I believe the average of these, where's my summary box? I believe the average of these is 35%. So that's the average. The average is 8% more than what we've had. All right. So that's where we are with recession. The data hasn't changed a lot since last week. We Got some unemployment claims figures, but that's still kind of muted, and it's because we haven't reached a breaking point with jobs yet. Perhaps we will. I'm going to flip through these and make sure there wasn't a chart that I really wanted to show you guys that I neglected to. No, it looks like that was it. Okay. So I'm going to talk about Bitcoin on chain, but I'm going to answer this last question. Do I believe any kind of crisis is likely to happen in upcoming months based on historical projections, i.e. a housing crisis? It's possible. So there's a tricky aspect to this, right? Many times when we've had recessions, when we've had bear markets, many times we've had some kind of a black swan. And that was the thing, right, that like really set us off. In 2007, 2008, it was the revealing of the shadow banking system by the collapse of Lehman Brothers, and the catalyzed by, excesses in subprime housing. The housing crisis was there, but really it was a collateral shortage. It was a call on collateral globally that really made it really bad. That was the black swan. But in COVID, right? COVID, we had a 35% drawdown. We know that it wasn't really a full-on recession. It was more of an economic shock, but it counts as a recession because of its severity. And that was driven by shutting down the economy, right? Various states started locking down, and that created a cascade and a rush for dollars. But 2000, there was no black swan. There was nothing. Nothing happened. The market just got too high. The math just didn't make sense anymore, and things rolled over, and we had a recession. So there doesn't always have to be like a thing that happens. In 1981, 82, back in this period, is because inflation was out of control. Well, today it's not out of control. It's high. It's uncomfortably high for the central bank and for people, but it's not double digits, which it was for this entire period of time right here, virtually this entire period of time. So that was partially their catalyst, but the black swan was really the Fed itself. It was Paul Volcker's willingness to step back and allow the free market to take federal funds rate where it would go. Paul Volcker did not sit at the head of the FOMC meeting and say, Fed funds is going to 19.5%. He just got out of the way. He just realized that controlling the rates was not in his best interest, and that they needed to expand the fence in which it should play and allow the market to find its equilibrium. And that equilibrium was a 19% Fed funds rate. That was kind of the catalyst, right? And in the 70s, we had a couple of oil shocks that catalyzed things. That was part of it here in 1973. But they don't always have to be there. So I don't try to predict what it's going to be. But what I do know is that the market is more overvalued now than it historically has ever been. And when you look at things like tech versus the S&P, it's at generational highs. And the only other times it's been that high have been major corrections in the market, like 2000. So I don't try to predict black swans. I don't spend a lot of energy pondering it. I know that there are risks out there. There's risks in commercial real estate. There's risks in sovereign credit. There's all kinds of problems out there. There's risks to the consumer being able to continue to afford a cost of living that has gone up by 30 or 40% in a couple years when their incomes haven't gone up that much. And they're running out of the free money that they were given a couple years ago. So that's a long-winded answer, but I don't really think about crises. Sure, it can happen. This is the kind of environment that is ripe to allow something like that to happen. And when I see the rates of change of the economy slowing down, certain things have picked up, but the job thing has me on high alert, and other components of jobs look really weak. Like we haven't even gotten into hours worked and things like that across multiple sectors, declining in a concerning way. Those things can create an environment where the market can be surprised. and it consistently is surprised. No matter how much information travels, no matter how quickly it travels, no matter how many people are watching, the market is still continually surprised by what actually happens. So I have no doubt that if things continue on their trajectory and we don't see a widespread uplifting in economic activity and inflation ceasing to be a factor, and the Fed, casually and elegantly bringing interest rates back down to a more neutral level, and we just continue to expand during that whole time. If they pull that off, amazing. Maybe we won't have a crisis, but we can't call victory on that yet. Okay. So here's what I want to talk about for the last little bit of the stream. I want to talk about on-chain with Bitcoin. And I want to give you guys who actually come to my videos and listen to what I have to say more insight into how I'm thinking about this than the people on Twitter get, because people on Twitter are jerk-offs. So I posted this yesterday in response to a tweet from someone else who I don't even know. Things just show up on my timeline, where someone said that this is the first cycle where I don't. This isn't about this person, so I don't care about who this person is. I just want to talk about their tweet. This is the first cycle where supply is being ripped off exchanges at a frantic pace. Do you understand what this means? And the suggestion, I don't know what their suggestion is, but what I wanted to provide, and what I feel I did provide in replying to this, is context about this metric and how people should actually be thinking about it if they're going to talk about it. And if you don't want to talk about exchange balances and post tweets about it to thousands of followers, then what I have to say doesn't matter. If you're a long-term buy and hodler and you don't follow the markets, then you shouldn't be looking at this data anyways. But if you're going to talk about it, then you need to understand the nuances of it. It behooves you to at least know what they are. So I replied to this and I said that coins are not flying off exchanges. There's actually a lot going on inside of this data here that many people just don't quite understand. And I want to spend a few minutes talking about it, because exchange balance gets looked at by a lot of people. It's one of the kind of introductory metrics for people who are interested in on-chain information, who are interested in Bitcoin analysis beyond the price chart. It's a popular metric. So me being someone who has unique knowledge about this metric, because I worked at Glassnode and one of my good friends in the space is the head analyst at Glassnode, and we have conversations about this all the time, then I have things to say about this. So exchange balance, first of all, is not capturing the entirety of exchange balances. Let's go ahead and establish that now. When you look at an exchange balance, what you are seeing is a selection of entities that Glassnode is showing to you, and that they have decided these addresses that we are tracking, these constitute the balance on this exchange, and we're going to add it to what we call exchange balance. Some of you have heard me talk about some of these things before. There are many other exchanges that are not included in this. Some of them are very small. You could argue that we have captured a relevant sample size of the total market in here. That's a valid argument and probably true. But there are large entities, some of which have lots of Bitcoin, and we don't see them at all. Those are like Robinhood, or even places like Fidelity. There's also larger entities, which I'm about to tell you about in a second, called Fireblocks. We don't see any of those. There's also a lot of other smaller exchanges like Vertex and Femex and Prime XBT and blah, 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 blah. There's countless dozens exchanges. Well, there's only like 24 of them inside this orange line here. So first of all, it isn't all exchanges. And then second of all, there are even nuances inside of what you are seeing. So what you're seeing is Coinbase, Binance, and a couple dozen other exchanges. One of them, Coinbase, this blue line, has been falling since early 2021 in a very mechanical, stepwise way. You see this here? It's unmistakable. It doesn't look anything like the orange line. right? This is mechanical as hell. This looks like an illiquid market. It looks like someone occasionally on a schedule of some kind moving large chunks of Bitcoin off Coinbase. That's what it looks like. And because this is the second largest exchange, then it falling is naturally bringing down this orange line. However, if you take Coinbase out of the orange line, you get the red line. And what you will find is that it hasn't even gotten below the bull market low. It has actually been a net positive. It has been a net gain since the bull run began in late 2021. It's actually up. And if you zoom in on this chart even more, it's up in 2023. So what I pushed back on, and what a bunch of morons decided to criticize me for, was pointing out that the characterization of coins flying off at a rapid pace is just simply false. It's just not true. This is the line since the beginning of the bull run in late 2020. This is the line this year. So it's not going anywhere. Has it gone down since June? Yeah. Okay. For a couple of months. Who cares? The point is that it's not really going anywhere. Now, over time, this will continue to drift lower as the market matures and there are more and more institutions that hold Bitcoin and service clients. Because there's no way on planet Earth that Glassnode is going to keep up with all of them. This is the list. This is all they have. Robinhood is not on here. Femex is not on here. PrimeXBT is not on here. Vertex is not on here. Didix, whatever the fuck. I'm just naming exchanges. There's tons of them. There are also many in other countries that I don't even know about. None of them are listed on here. This is not a knock on Glassnode. Those guys are amazing. I'm friends with those people. This is not a critique of them in any way whatsoever. This is how the data works. This is how it works. And so if you're going to make statements like coins are flying off exchanges, you're suggesting that there is some like self-custody wave that is taking over the market, you're misunderstanding these dynamics. So why is Coinbase doing this? I think is the question on many people's lips. Why is this? What's happening here? Well, friends, these coins are still largely with Coinbase. They are in Coinbase custody. They're held by people like MicroStrategy, large entities that use Coinbase as their custodian. Coinbase custody is not included in the exchange balance number that is shown by Glassnode. I know that because I know the people at Glassnode and I have asked them. So multiple people told me I was making this up. They asked for my sources. My source is literally the fucking logo in the middle of the chart. Okay? I worked there. I know what I'm talking about. So Coinbase is moving coins into Coinbase custody. And because those represent a different level of custody, there's more friction involved in the movement of those coins. Glassnode simply doesn't list it among the exchange balance for Coinbase. It's not part of the, for lack of a better term, quote unquote, public exchange balance, right? It's kind of in what I termed hidden custody. It's not hidden on the ledger. It's just hidden from you and me. Glassnode can see it, and they have made the executive choice for the integrity of their data not to include it. But it is still held by Coinbase. And so if we just take that out, we just remove that dynamic because it is creating noise, then we can see that by and large, exchange balances haven't gone anywhere. Look at this. They haven't gone anywhere. This goes back to 2019. If this was a price chart, you would say it was ranging. So why is that? Why is this happening? Why do I care? Well, I like to share valid information for people. I like folks to understand the metrics that they're looking at. And I also want people to understand that the Bitcoin network, the asset, the financial ecosystem within Bitcoin is much larger than you think it is. It's much bigger than this orange line on the Glassnode chart. Much bigger. And in fact, like just to show like the scale of how different these lines are and why it's important, is because if you look at Coinbase and you see that since the beginning of 2021 they're down 500,000 Bitcoin, but you know that a huge chunk of this is still belongs to them. The rest of the exchanges are up 165,000 Bitcoin in the last 2 years. If we add Binance, here's just the raw chart. This is the change since early 2021. You can see all other exchanges are actually up. But this is the three lines together. This is all exchanges. Orange is Coinbase, and this turquoise is the blue line minus Coinbase. But what if we throw Binance on here? Here's Binance in red. It's going up. Binance is having more Bitcoin put on it over time. So this entire narrative about coins flying off exchanges is total fucking bullshit. It's a very flimsy narrative. You might be able to find some little pocket of time, like from June to now, where all exchanges saw an outflow of a certain amount of Bitcoin, but like, zoom out, dude. Zoom out. It doesn't matter. And I'm going to throw something else at you that just further nullifies the relevance of this metric, because I think exchange balance is meaningless and that people should stop using it to tell their stories. Tell their stories about Bitcoin. Let me throw something else at you. There is an entity called Fireblocks. Now, Fireblocks is a crypto custodian. They handle thousands of clients. They are connected to every major player in the crypto space, including every exchange, including liquidity providers, including asset managers, including large TradFi banks like New York Mellon and BNP Paribas, like major clients. They have a self-contained network called the Fireblocks network that is plugged into all of these entities. And there is some interesting things about the Fireblocks system that you should be aware of if you're going to talk about Bitcoin's ecosystem and the amount of value that goes through it, and try to look at stuff like exchange balances and detect, what's going on in the market. You're not going to know it because of places like this. And I found an article on their page and they talk about their product. And so what does Fireblocks say they are? They were initially a software custody solution to secure cryptocurrency assets, but they've now pivoted to be a platform securing trading transaction connections between customers. The Fireblocks platform serves as the infrastructure for transactions between parties. The platform gives traders access to almost 2,000 liquidity partners, trading venues, exchanges, and counterparties for secure trading. The platform enables direct connectivity to 30 plus exchanges. 30 plus, that is more. Sorry, I'm jumping around. That's more than is in the Glassnode exchange balance. They don't have 30. And access to over 1,000 tokens. On Fireblocks, transactions happen from a single account and settle with trading partners in minutes. Fast transaction settlement is critical for the liquidity of Fireblocks customers and large over-the-counter trades with third-party aggregators across many exchanges and parties. What does that mean? Well, that means that Fireblocks is a self-contained ecosystem of economic activity. And when you look at how they describe their product, with the Fireblocks network, you have access to the entire crypto capital market ecosystem directly connected to thousands of the largest entities through our Fireblocks API. And where was the other? There was another page here. Instant settlement. Connect and settle instantly with any counterparty or trading venue on the network. Well, how do you think they do that? It's because they have their own pool of liquidity. There is Bitcoin in this network, and it is the aggregate of those 2,000 massive players that are their clients. And the interesting thing about this network is that they can service economic transactions between these players that do not make it to the major exchanges balances, that don't show up on chain, and all we see is the trace elements of the P&L differences between those entities that does make it on chain. It's like a commercial bill of sale network that's within Bitcoin's ecosystem. One of the guys in the space, one of the other analysts, to show you that this isn't just me making this up and that other on-chain analysts also know this, this is Capriole. This is Charles Edwards. He's a crypto on-chain analyst. He's the guy that came up with the hash ribbons and the mining price, cost of production, those indicators. That's the guy. This is his newsletter from January of 2022. He talks about this in his newsletter. He's talking specifically about exchange balances here. Pay close attention. A useful on-chain metric to explain large shifts in sentiment is exchange reserves. However, this metric has become subject to a drastically changing Bitcoin landscape. The custody platforms institutions use, like Fireblocks and Copper, etc., store their coins off exchange in cold storage. As of 2021, these platforms have allowed for credit lines, this is important, have allowed for credit lines to be established between exchanges and custodians. This means Bitcoin can be traded in massive size on exchange, even though the coins have been moved off exchange. Only the profit and loss needs to be settled between the custodian and the exchange. The necessity to move coins out of wallets in order to make investment plays is not as critical as it once was. It wouldn't be surprising to see raw exchange reserves reduce with time, as these coins are pooled with custodians and other lending and bank platforms. As long as institutions and whales dominate the Bitcoin space, consistent exchange reserve outflows matter less than they did just 12 months ago. This was in January of 2022, 18 months ago. The signal of exchange reserves has diminished in light of a more complex crypto landscape. It's because of Fireblocks and Copper and their ilk. BitGo is another one. Because they provide instant settlement between major players in the space. And none of that actually has to happen on Coinbase proper. So when people look at data that relates to the Bitcoin network and they talk with certainty about what it means for what the hodlers are doing, or what price is going to do, or how much supply is quote unquote available, they're talking out of their asshole. They don't know enough to definitively make those statements. I do, and I'm telling you that this is the truth. So stop giving a shit. Frankly, just don't care. I don't even look at this metric unless I see people say things about it that aren't true, and then I go and I provide my context. And you know, the only people who have a problem with me making critiques of Bitcoin and Bitcoin on chain are people who need the narratives that I shoot down for their own peace of mind and their own engagement. Those are the only people who ever complain to me about the things that I'm saying, who say I'm a LARP, who say that I wake up every day with my sole motivation being to be a contrarian. And if that were true, then it would be really hard for me to have this much data behind the things I say every time, if my sole goal was to be a contrarian. If that's all I cared about was just telling other people they were wrong, I would really struggle to find all of this statistical hard evidence and the people who actually make the fucking data telling me that I'm right in private conversations. All that would have to stop happening. So that's what I have to say about that. I feel like I'm real spicy today. I get passionate, you know? I find this stuff amazing. I think Bitcoin is one of the greatest financial discoveries in human history. It's changed the world in terms of the way we think about what money can do and what it can be like. But it hasn't changed the world with capital letters. It hasn't gotten there yet. It's still just this tiny little thing that is worth less than multiple US companies. And I think that the narratives frequently get far out ahead of the actual data and the reality that we face. And I don't bring up reality to shoot down people's dreams. It's because those who don't know better get suckered into believing things that aren't true. And those become a beacon for people to gather behind and to use as motivation for why they're allocated to something, why they study something, why they follow all these influencers. And they need it. They need a tribe. They need a philosophy to get behind. And when those things turn out to not exactly be the way that they were characterized in the beginning, then people get defensive, and that's understandable. You know, the goal here is not to offend anyone or to make people feel bad about their investments. The goal is to reality check you into being an adult about the market. So I will never stop being this way. This is the unvarnished version of me, always. I have always been like this. And if I ever find that the data has changed, or there is some new thing that makes what I said before not relevant anymore, then I will say that, because that's what the data is telling us, because that's what the truth is. Because I'm not clever enough to come up with stories. I'm not the kind of creative mind that can just conjure some amazing narrative about what hodlers are going to do. All I can do is look at the data and use my rational framework and my cashew brain to try to figure this shit out. And there's a lot of people on Twitter who don't do those things, or they think because they have some passing understanding of supply and demand because they took an economics course, that they can tell you what Bitcoin is going to do because it has a fixed supply. When those two things could not be further apart in the types of understandings that they require. I love this shit. Bitcoin's going to change the world, but it's going to take a long fucking time. I don't think that it's going to have some orange swan crazy breakaway bull run. I don't think that we are on the cusp of trillions of dollars rushing in just to Bitcoin because they've been kept out of it. Like, if those things are true, then that's going to be amazing, and the data will show us, and we will talk about it, and we will be excited together. But if I'm telling you what I think that we have a very long way to go. I think that the market teaches people in a very savage and Darwinian fashion. People do not learn lessons about the markets and about money in an elegant way. They will not learn until there is a crisis. And so I think that that is bound to happen. And when it does, there will be some people who start to understand, man, maybe the current financial system is kind of fucked up, and maybe I really need to start learning. Maybe I need to take my own education seriously. People need to have that kind of revelation to start asking questions and to care. The price will make some people care, but it won't get everyone involved. And, you know, throughout time, what we have seen throughout the course of history is that people get carried away by narratives that don't match reality, and then there is a repricing. It's usually dramatic. It tends to be the one thing that everyone said could never happen. And then afterwards, there is, you know, a period where the asset can thrive because it is flushed out, not just the paper-handed holders, but it's wiped out all of the false stories and the misperceptions and the straight up wrong ideas about what it's capable of. Bitcoin has a lot of those. It has more of those than the average asset. And that's why you get so much passion out of people, because it has gone up, you know, 10,000% in a bull run before from zero, right? And people have made a lot of money from it. And it has done things that no one thought it was capable of doing. The technology has proven itself. But the application of that technology to society has not been proven on any level. And it will not be proven for quite some time to go. And until we get to a place where there is a notable percentage of market participants who agree about the value of Bitcoin, then it will be subject to the same misunderstanding and flows and speculative behavior and degen bullshit that other risky things are. The institutions are just going to FOMO in. People were saying that in 2020. Where'd they go? Where are they? Institutions don't FOMO. They build a position over a long period of time, and then they rake you over the coals with fees. All right. If you have any other questions for me, make sure you get them into the chat because we're going to wrap up here in the next few minutes. We've been going for almost an hour and a half, and that's about as long as I want to keep these streams. What I'm thinking about doing, and I'd be open to hearing y'all's opinions, what I've been thinking about doing is cutting up my streams into a couple of short little videos that are just maybe a couple of small observations or segments from the stream and releasing them in between streams as like either a YouTube short or just a small regular video for people who don't sit and watch these things, because I think it would help the channel to get more visibility. But I don't want to spam, I don't want to spam my feed with videos that are just cut up versions of other videos. So I just wasn't sure what y'all thought of that idea. But anyway, I come at this from a place of genuine interest and passion and a yearning to understand. I don't have an agenda to prove people wrong. I don't care about being a contrarian. What I do care about is providing contextual information when I think that there is a lack of understanding or a lack of respect being paid to the total picture of any given topic. That often happens on a place like Twitter, where you are limited in what you can say. But all right. Please subscribe to the channel if you have not. We're going to pull it up here. Alpha Beta Soup. YouTube.com. That's not the one. If you are not subscribed, please hit that subscribe button. If you want to find out every time I go live, please enable alerts for the channel. What I have been told by some people is that because I took a few months at the beginning of the year where I didn't put out a video, that their notifications are not being sent to them, even though they have them turned on. So if you're one of those folks, go back to my channel, turn off the notifications, and then turn them back on and see if that fixes it. But yeah, that's where we'll leave it today. We will do another stream next week. We are doing these weekly from now on. We might do more videos, but I think for now, a weekly live stream and possibly releasing some smaller cut up pieces from the live stream might be what I do. So anyways, I love you guys. Thank you so much. Make sure to share this live stream with your friends. Y'all getting the word out is far more impactful than me doing it, because I talk about it all the time and everyone who wants to be here is already here. And yeah, we'll talk again next week. Take care of yourselves, friends. Take care of each other. Let's do a last check on the BTC price before we dip out today. It's at about 36,360. It's pulled back from 38,000. Crypto, in general, things are down 7, 10. TRB's down 20%. But we'll look for this bounce here, and we'll talk in a few days. So until then, hope you have a great few days. Hope your weekend is really enjoyable. Get outside and touch some grass. Hug your kids. Hug your cats. Hug your dogs. And we'll meet again in 7 days' time, buddies. I love you. Thank you. Cheers, everyone.